Good evening, guys. Today I'm here to talk to you guys about home financing agreements, which is generally called a mortgage, which is essentially a contract. And always read and understand the terms of your contract. That's the whole gist of this video. Always read and understand every single term in your contract so you can know if you can fulfill that contract or not. And if you are confused, honestly, not even if just you're confused, because sometimes you don't know if you're confused until you're confused. So with that being said, always get a second opinion that's not the mortgage company. Always ask and see if you're going to be able to fulfill the terms of the contract. Do your research and see if you can fulfill the terms of the contract. But that was the big picture. Small picture here is we're going to go over a few types of mortgages. We're going to go over the traditional mortgage. We're going to go over modifications. We're going to go over shared appreciation mortgages and reverse mortgages. So yeah, a traditional mortgage involves the borrower paying off the amount borrowed plus the agreed upon interest. If the borrower sells the home after they pay off the entire mortgage, the borrower owes the mortgage company nothing. But if the borrower sells the home prior to paying off the agreed upon amount, then the proceeds from the sale goes to the mortgage company. Sometimes you need modifications. Sometimes people fall behind on their mortgages and they ask the mortgage company for modifications. And they'll give you something called a balloon payment. And the balloon payment, it'll lower your interest and it allows you to keep your home if you fall behind on your mortgage. However, a balloon payment is generally twice the amount of a loan. So what that means is you'll agree that in like 10 years, you're going to pay the mortgage company $30,000 up front. If you don't have $30,000 up front, if you know in 10 years you're not going to have $30,000 up front, you should not sign that because you can risk losing your home. And then we have these things called modifications. And generally, it's again the borrower asking the lender for a reduced mortgage or reduced interest rate. And the mortgage company will grant it if you fall behind, if you fall into hardship. But generally, they won't grant it if you don't have no job whatsoever. And it's different from a forbearance because a forbearance is a temporary loan agreement where a modification is permanent. However, the cons for a modification is that you'll often be paying for a longer time period. And so you'll be paying more money over time. But the pros to it is, like I said, they'll give you a lower interest rate. And, it's helpful. So modification is lower monthly payments, can help the borrower avoid foreclosure, and is less of a negative impact on your credit than foreclosure. However, it's still a negative impact on your credit, and also you'll be paying for a longer period of time, and you'll be paying more interest over time, if that makes sense. So yeah. Then we have these things called reverse mortgages, which are refinancing agreements for people over 62. And the borrower receives a percentage of their home equity that they do not have to pay back until the borrower either sells their home or passes away. The pros is it can give you money for the expenses you're behind on. There's no monthly payments and there's no interest rates, That's great. The cons to a reverse mortgage are it can impact someone's eligibility for SSI and Medicaid. Sometimes and often, the borrower has to pay an origination fee or a monthly service fee. So that means you have to pay a small amount, like maybe $300 or maybe $80, depending on the company. But you have to pay that every month. Or the origination fee is like up front. You have to pay like $1,000 up front, origination fee. Anyway, and you must be able to pay your property taxes and homeowner insurance. If you can't pay your property taxes or your homeowner insurance, you still can go into foreclosure. And again, it's unlikely that your heirs will be able to keep their home because you'll be able to keep your home once you pass away, because if you pass away, they got to pay the entire loan back at that one time. and the mortgage company generally doesn't negotiate with them. The last type of mortgage is a shared appreciation mortgage. Again, this is not the only type of mortgages. It's way more mortgages. It's way more ways they can make agreements and deals with you. Way more different type of stuff going on. But we just sticking to the basics. So in the shared appreciation mortgage, the borrower agrees to share a percentage of their home appreciation with the lender. So what that means is the borrower asks the lender for $20,000. On top of that $20,000, like the borrower has to pay that $20,000 back. But on top of that $20,000, the borrower also agrees to pay a percentage of their increased home value. So if the home increases by $100,000 and in the contract it says they have to pay the lender 20% of their home appreciation, they have to pay the lender in total $40,000. $20,000 of the loan and $20,000 from the percentage, the increased percentage. So when they sell their home, they have to pay them that $20,000, even if they already paid off the full amount of the loan. The pros to a shared appreciation mortgage is often there's no monthly payments. If an individual has poor credit, it's helpful because they often don't do credit checks. They often don't require you to show a proof of income. If you pay off the full balance, some lenders do not require you to pay off the appreciation, but that must be stated in the contract. If it's not stated in the contract, then the lender's not going to do that. And also, you may not owe any money at sale if the home value does not appreciate. However, some lenders put in a loophole that says even if the home value doesn't appreciate, you have to pay a certain amount of money. Like they have a if-then type of clause. The cons is you must share part of the profits of your home with the lender, even if you pay off the full advancement. You may still have to pay part of the appreciation even if you do not sell the home. So they'll have a clause in the contract that says that if you don't sell the home in 10 years, you still have to pay off, you have to pay you have to pay a percentage of the appraised value. So they'll get an appraisal to appraise the home after 10 years, and you have to pay a lump sum amount, similar to like a balloon payment. And you must pay an origination fee up front. And investors can transfer the appreciation interest to an additional investor. That's also for other mortgages as well. Make sure you read your contracts, because often mortgage companies can give another mortgage company your mortgage. So you're not even dealing with the company you originally contracted with. So in conclusion, there are pros and cons to all financing and refinancing agreements. It's risks and rewards to everything. But the most important thing is that you read and understand all the terms of your contract and of your agreement. In addition to understanding the terms of your agreement, be realistic with yourself to decide whether you will be in a position to pay such loans. Make sure you will be able to fulfill the terms of the contract. Knowledge and land is power.